Take a look at U.S. stock futures this morning. We are down across the board fractionally here following the latest read on the Fed's preferred inflation gauge, core PCE. Inflation rose at a stubborn pace during February. Personal spending came in slightly weaker than expected. Joining us now, we've got Thomas Simons, who is the Jefferies chief U.S. economist. Thomas, great to see you. Thanks for joining us this morning. Just take us into your reaction to this print.
Good morning. So I do believe that the inflation trend overall is not really inflecting higher. I know that there's a temptation to believe that based on the fact that tariffs are coming in. Obviously, the price level is going to rise on a number of different things, but the implementation is not immediate. I don't think that we're inflecting towards some sort of demand-driven higher inflation environment. We did miss, a little bit to the upside here with the February PCE data, especially relative to the CPI data that we saw earlier this month, which was a little bit softer. I think the CPI is more indicative of the trend. We're seeing lower energy prices, falling gasoline prices, and also, the continued disinflation in shelter that we're seeing. I think that those will push towards a more modest inflation environment in the months to come. And I think that's what is more important to keep focus on.
So where does this leave the Fed, Thomas?
The Fed is pretty comfortable in their sort of no hurry mode right now. I do think that this particular print is not helpful, but if what I expect for the next couple of months does continue to play out with more modest inflation, and again, no details here really suggested that that view is wrong. I do think that it leaves them in a position where they can respond to the potential impact of uncertainty on the labor market later on this year. I'm still expecting that they're going to cut by mid-year and probably have 3 rate cuts in June, July, and September.
Thomas, with that in mind, it really kind of puts us in this predicament where we're trying to figure out how much the labor market will also continue to impact the mindset of the consumer, where we've already seen that start to show up in some of the confidence prints there. And then at what point is there a large enough trend that the Fed needs to act on? And if July is that point, then at what point later on in the year will the Fed also potentially have to take even more action if there is further deterioration?
So I think once we get through the issues with in Congress with the budget debate that's going on, after we get a few rate cuts from the Fed, and once the policy focus starts to shift towards more pro-growth, domestic policy offsets to potential tariff impacts, I think the second half of the year we could see a return to stronger growth. I don't think July 1st is necessarily the day that you should expect that the tone is going to change. It could be Q4, for instance. But I don't think that a cutting cycle that's engaged by the Fed, by mid-year is going to be particularly long or deep. Much like what happened in September, I think that it's very likely, September of last year, I should say, I think that it's very likely that once they start cutting, they'll start to see better data that maybe suggests that they don't need to cut nearly as much as they do in true downturns.
I want to get your take on the tariff policy because in the PCE data, we saw perhaps some evidence that it's already impacting consumer spending. You had durable goods spending rising 1.4%, car spending up. Meantime, you had people spending less on things like food services, for example. Perhaps an indication that people are already recalibrating their personal budgets in anticipation of those tariffs. At what point does the nature and the headlines surrounding these tariffs become sort of unrecoverable when it comes to the consumer sentiment impact?
Comfortable is a word I think that's, I'm not really, particularly concerned with. I do think the consumer remains fairly resilient. I do think that there is, I would agree with you that there are clear indications that people are nervous. If someone is employed by the federal government, for instance, they've had this kind of on again, off again, am I employed, am I not employed thing going on, which is, respectably very, concerning. That's going to restrict spending. People who are adjacent to the government, same kind of thing. But I do think in the next few months, we're going to realize that the DOGE actually doesn't cut jobs itself, and that the job cuts are going to be fairly limited. And, in terms of consumer sentiment, rising prices are a potential concern, but if prices don't rise quite that much, then I think we'll see the strength of household balance sheets will weigh out over the concern and sentiment. And people, especially the top end of the income distribution that's been driving growth this whole time, will continue to drive overall growth. I'm certainly sympathetic to the bottom half of the income distribution. It is a very challenging environment to be in. But if they pull back a little bit, it frankly, just based on the math, doesn't drag down growth into recession territory.
As we were kind of wading through both the data this morning and also looking out into next week and the potential continued impact of what the tariffs could look like, I was kind of pairing that with what we had seen from Apollo's chief economist, Torsten Slok, who had said tariffs unfortunately have two short-term negative effects on the economy: elevated uncertainty, negative impact on household and corporate spending decisions, and then also a negative impact on corporate earnings as companies experience higher production costs. As you're kind of looking through some of the nearer term impacts that you would be watching closely to make sure that there's not a longer term implication, what would that be from what you can kind of estimate at this juncture?
Yeah, I mean, a very difficult exercise, quite honestly. I tend to think that if we're expecting that there's going to be some sort of long-term impact, you have to assume that that means there's going to be some sort of tit-for-tat back and forth where tariffs escalate ad infinitum. And if that's the case, then short of the government directly stimulating the household sector with checks to offset the impact of tariffs, there's no reason to believe that market forces can continue to support higher and higher inflation. So, there will be demand destruction by tariffs if they go higher and higher. I think that as it stands right now, and based on the positioning that we've seen from trading partners looking to cut deals, my guess is that what we're looking at right now is the worst case scenario, and that what eventually comes to play out will not be nearly as onerous as it looks like today. That is a little bit of a Pollyanna view. I tend to be an optimist, but maybe I'm leaning a little bit too far into trusting that these policies are going to be executed on properly. But I would agree with Torsten that the first half of this year is probably going to be quite poor. We'll probably see a Atlanta Fed GDP now estimate that's going to be out later on this morning, more negative. Even the ex-gold model that they use to offset the imports that we've seen from I think from Europe in gold, like they'll probably turn negative as well. And it will spark more recession fears as we start to pencil in potentially negative GDP prints for the first 2 quarters of the year. But I don't think that the economy is vulnerable enough such that we have the potential for really significant negative feedback loops to develop and really cause destruction that takes a long, long time to put back together.
Hey, we'll take a Pollyanna view from an economist, Thomas. Thank you so much for joining us. Really appreciate it.
Of course. Thank you.